Welcome to this special episode of the Third Umpire. Now, as we come to the close of this calendar year 2023, we look back and see how this year has been yet another roller coaster, but also has been an interesting year for investors like you and myself. Now, in today's episode of the Third Umpire, we will look at how the Indian markets have performed in the last calendar year of 2023. Then we will look at some of the key events which have played out and shaped up the markets in 2023. And lastly, we will delve into the events that are anticipated to pan out in the next year of 2024. You're watching Informed Investor, the Third Umpire, an initiative by Research and Ranking. Let's begin. Now, in the backdrop of heightened geopolitical tensions and a generally subdued global economic environment, the Indian stock market has displayed a remarkable resilience throughout the calendar year 2023. Notably, key benchmark indices, namely the Nifty 50 and the Sensex, achieved significant milestones, reaching the impressive marks of 21,000 and 70,000 respectively. Now, what's even more noteworthy is that just this week, the Indian markets once again have reached their respective all-time highs. Now, the Indian market commenced the year 2023 on a very somber note, with the Nifty 50 experiencing a decline of over 2% each in the initial 2 months. Now, the index recorded negative returns in 4 months out of the entire year, which is January, February, August, and October. Now, one of the standout features of this exceptional year has been the notable rally in the mid and the small cap stocks, accompanied by a historic surge in the number of IPOs, or the initial public offerings. Now, small and mid cap stocks have notably outperformed their large cap counterparts as well. Now, even the primary markets, which had the lackluster start to the year, have regained their vigor in the recent months. The number of IPOs has seen a remarkable surge, creating a thriving IPO market that is attracting new investors to the newly listed stocks. Now, the driving force behind this year's outstanding performance can be attributed in part to the gradual return of the foreign institutional investors, as we know them as FIIs. Now, these investors had withdrawn from the Indian market in September and October due to global uncertainties, but have made a strong comeback since then. In the month of November alone, FIIs infused a substantial 9,001 crore rupees into the Indian equities, followed by an even more significant 57,313 crores in the month of December. Now, as a result, India retained its status as one of the most favored destinations for foreign portfolio investors throughout the year. Now, additionally, the domestic investors consistently played a supportive role in bolstering the market forward. Now, it's also important to note that global agencies have expressed positive views on India's economic prospects. An S&P report predicted that India, currently the world's 5th largest economy, is poised to become the 3rd largest economy by 2030, surpassing China. Morgan Stanley upgraded India to a standout overweight status, considering it their most preferred emerging market. CLSA, a global brokerage firm, has also upgraded India to overweight and increased its India allocation. Nomura, another global brokerage firm, upgraded India from neutral to overweight, citing a strong top-down narrative and potential benefits of the China Plus One theme. Now, these developments do highlight the positive outlook for India's economic growth and its appeal to global investors. Now, as we delve into the sectoral performance of 2023, the auto and real estate sectors have notably outperformed the benchmark Nifty. However, the standout performer amongst them is the Nifty Realty Index, with a staggering 70% growth year to date in 2023 alone, outpacing the 48% growth seen in Nifty Auto as well. In comparison, the benchmark Nifty 50 itself has recorded a respectable gain of over 19% during this period. Now, let's look at some of the key market events that played out in 2023. Now, in the dynamic landscape of the Indian stock market in 2023, several key events have left a lasting impact on investors and market participants. We will delve into some of the noteworthy occurrences as such. Now, the year kicked off with a significant event as Hindenburg Research leveled serious allegations against the Adani Group. Now, the research firm claimed that Adani utilized a complex network of companies in tax havens to artificially inflate revenue and stock prices while accumulating substantial debt. Now, the release of this report triggered a massive sell-off, causing the market value of all the 9 Adani Group companies to plummet by as much as 1 lakh crore rupees. Gautam Adani, once ranked number 2 in the global rich list, saw a dramatic fall to rank number 21 in early February. Now, against the backdrop of the Adani controversy, the Indian market underwent a significant structural change by transitioning to a T+1 settlement on January 27, 2023. Now, this move was aimed to enhance market liquidity by shortening the settlement cycle. The shift to a T+1 settlement has allowed buyers and sellers to receive shares as well as corporate actions such as dividends and bonus shares in their accounts just one day after the market closes. Now, this change is expected to improve overall market efficiency, reduce the risk, and provide quicker access to money or to securities, as the case may be. Now, this was followed by the Union Budget. The Union Budget for the fiscal year 2023-2024 was marked by pragmatism, navigating the delicate balance between managing fiscal deficit and alleviating the impact of high inflation on the residents of the country. Now, the budget focused on high capex, a roadmap to reduce fiscal deficit, and measures to boost consumption. Notably, an overhaul of the income tax structure aimed to put more money into the hands of the middle-class taxpayers, fostering increased consumption and investing across various options available to them. Now, following the budget, attention turned towards the RBI, or the Reserve Bank of India, meeting where the interest rates were decided. Now, in a move to address the economic concerns, the RBI raised the repo rate for the 6th time since May of the previous year. Now, the cumulative increase amounted to 250 basis points or 2.5% since May of the previous year. Now, this decision was a part of the central bank's strategy to manage inflation and balance economic growth. Now, the move had significant implications for borrowing costs and overall economic stability, as we've also seen. Now, this was followed by the banking collapse of Silicon Valley Bank, Signature Bank, the First Republic Bank. The crisis was triggered by significant losses in cryptocurrency investments, declines in bond portfolios and commercial real estate investments, and intense withdrawal from the bank deposit. Now, following these events, stock prices of US regional banks dramatically fell, fueled by diminishing investor confidence and concerns about potential impacts on other banks and the banking sector collectively. This brought back the alarm bells, what we had seen in 2007-2008. We also saw a repercussion of this for Indian banks that had exposure to startups in the US and Europe. There was also a knock-on effect for IT firms that had BPOs and other services for US and the European markets. In mid-March, Indian stocks therefore dropped 11% during the January to March quarter, which was the most amongst the world's top 10 markets by value amidst continued selling by foreign investors. Now, the drop in aggregate Indian market capitalization was the biggest since March 2020 quarter, when COVID worries had first surfaced. Now, post this, to bring some respite to the markets after raising repo rates in 6 consecutive policy meetings, the RBI, in a surprise move, decided to pause its rate hike cycle. Now, it was widely expected that the RBI would raise the repo rate by another 25 basis points and then choose to take a pause. Now, this was on the back of inflation easing from 7.7% to 5.66%. Now, the current level of inflation is within the tolerance range of the RBI, which targets an inflation rate between 2% to 6%. Now, after this, in the month of April, there was a report on how India had overtaken China as the world's most populous country according to UN population estimates. Now, the most significant shift in global demographics since the records had actually began was this one. Now, according to UN's projections, which are calculated through a variety of factors including census data and the birth and death rates, India now had a population of 142 crore 57 lakhs 75,850 individuals, surpassing China for the first time. After this, in the month of May, the mighty rupees 2000 note, introduced in a whirlwind of financial chaos back in 2016, faced its own demise. The 2000 rupee note was introduced primarily with the objective of meeting the currency requirement of the economy after the legal tender status of rupees 500 and rupees 1000 notes was withdrawn. Now, one significant impact is the reduction of the parallel or informal economy, since the individuals will be compelled to conduct transactions through official channels. Now, by discouraging informal transactions, this move was aimed to promote transparency and accountability. Now, another advantage is the diminished risk of counterfeiting. Now then, in a path-breaking move in the field of global trading in India, the popular SGX Nifty was rebranded as Gift Nifty from 3rd of July, and all the derivative contracts worth $7.5 billion, which were earlier traded in Singapore, shifted to India. Now, the beginning of the operation of Gift Nifty was a significant step in the shifting of the base Singapore exchange to the NSE International Exchange in Gandhinagar, Gujarat. Now, we all know that Gift City, which is the new financial hub in Gujarat, is an initiative in which the government intends to develop a marketplace as a competitor of other global financial centers like Dubai, Mauritius, and Singapore. Post this, throughout the year, the US Fed's actions in response to high inflation levels and their impact on interest rates have had significant effects. Now, this was one of the key points for stock markets globally throughout 2023, and it had a ripple effect on the Indian stock markets as well. In the month of July, the Federal Reserve resumed its rate hike campaign, raising its target rate by 25 basis points. Now, this decision brought the overnight federal funds rate to a range of 5.25 to 5.5%, which was the highest level in over 22 years. Now, India's inflation hit a 15-month high. In July, the CPI inflation, which essentially measures the retail inflation in country, surprised everyone by surging to another high of 7.44%. This marked a 15-month high, and it certainly raised some eyebrows. The main culprit behind the significant increase was the food price component, fueled by vegetable prices, which rose. Now, this data had certainly caught the attention of experts, policymakers, decision makers, and even politicians. Now, fast forward to today, inflation then fell to a 4-month low of 4.87% in the month of October, but is expected to remain above the RBI's 4% medium-term target for a foreseeable future. While core inflation, which excludes food and fuel prices, has generally moderated, there are concerns about the potential increase in food inflation in the near term. Now, amidst all of this, in the month of August, India was celebrating as its moon mission Chandrayaan-3 scripted history by successfully landing on the lunar surface on August 23rd. Now, with the lander accomplishing a soft landing on the moon's south pole, India became the only country to have ever done so. Now we know that crude oil prices are a significant factor influencing economies around the world. Any increase has an impact on the financial markets as a whole because it usually results in increased prices for consumers and businesses collectively. Last year, due to the Russia-Ukraine war, oil prices rose to more than $120 per barrel. These high energy prices caused inflation rates to surge across economies and prompted the central banks to intervene and hike interest rates to counter high inflation levels. Now, this year, we started at $82 per barrel, and further on, weak demand concerns due to global growth slowing, the prices later fell to $70 per barrel. Naturally, this led to the major oil-producing countries reducing their output in an attempt to drive up prices. Then, the Israel-Hamas conflict erupted, and speculation regarding Iran's involvement further led to the rise in crude oil prices. When tensions arise in oil-producing regions, it can lead to problems with crude oil supplies, which leads to a rise in oil prices. But now crude oil prices are pressured on the downside once again. A drop in crude oil prices is positive for India because it imports the majority of the oil it needs, and a rise in crude oil prices increases India's import bills, which leads to further increase in the country's current account deficit and puts pressure on the Indian rupee. It also translates into higher costs for our businesses, eating up their margins. Now, investors who had been focusing for months on interest rates and inflation were now turning their attention to the Middle East. The conflict between Israel and Gaza escalated into a full-blown war due to a significant event. It all began when Hamas, a Palestinian militant group, launched a surprise attack that resulted in the tragic loss of hundreds of lives. This attack was met by retaliation from the Israeli army. Now, a geopolitical tragedy like this leaves investors with a conflict of interest. 2 days after the attack, both NIFTY and Sensex lost close to 1%. Now, on the back of this, global sentiment was weak. However, the Indian markets quickly rebounded. Now, in November end, the Indian stock markets achieved a milestone touching $4 trillion in market capitalization for the first time ever. This coincided with the Nifty reclaiming the psychological mark of 20,000 for the first time since September. Post this, we looked at India's economy, which grew by 7.6% in the second quarter of the financial year, which is the July to September quarter, exceeding analyst expectations comfortably on the back of higher government spending and a strong performance by the manufacturing and the construction sectors. Now, this number meant that India's economy had grown by 7.7% in the first half of the financial year. Now, post this, the GDP news came alongside the news of key electoral victories for the ruling Bharatiya Janata Party, and together, the two factors jump-started the Indian stock market's rally once again. Foreign investors were making a beeline to buy stakes in the Indian companies, even as domestic retail investors' involvement reached historic highs. When we look at December, the US Federal Reserve kept the interest rates unchanged for the third consecutive time in a very important development. The Fed chair provided a clear indication that the central bank plans to initiate interest rate cuts in 2024. Now, this was good news as an interest rate cut implies a softened US dollar and bond yields. Now, on the back of the Fed's decision, the 10-year Treasury yields dipped below the 4% mark, which was a notable decrease from the multi-year high of 5% recorded in the month of October. Now, when the Federal Reserve announces rate cuts, foreign investors tend to increase their investments in emerging markets like India in a lookout for better investment opportunities. In 2023, India stepped onto the global stage with confidence, shedding its traditional cloak of diplomatic reticence. Now, the year was marked by its assertive participation in shaping the geopolitical landscape, particularly through two key events. First being the G20 presidency. As host of the G20 summit, India championed the interest of the global south, advocating for multilateralism and economic inclusion. It navigated a complex international environment, deftly managing relationships with diverse players like the US, China, and Russia as well. Second, it took strong diplomatic positions. India emerged from the sidelines on critical issues, taking strong stances on the Russia-Ukraine war, promoting climate action, and upholding its regional security interests. This decisive approach showcased its growing stature and willingness to contribute to global governance. Now, while we've discussed about the major events that shaped the calendar year 2023, let's dive into the key events to watch out for in 2024. The first is the federal rate cut. In the latest FOMC meeting that happened in December, Federal Reserve had signaled interest rate cuts in 2024. Now, this move is expected to have a significant impact not only on the US economy but also globally. On the back of the monetary policy that will be adopted by the Federal Reserve, there is an anticipation of increased foreign capital inflows into the Indian markets. Second is the RBI rate cuts. The Reserve Bank of India holds the potential to be a major player in driving economic growth. If they decide to implement a rate cut, it could attract substantial domestic institutional investment inflows, providing a boost to the Indian economy. Third is the Indian elections of 2024. The upcoming Lok Sabha elections in India is another pivotal event, and the expectations of political stability post-elections are extremely high. The outcomes of the elections are anticipated to influence fiscal and monetary allocation, shaping the economic landscape for a foreseeable future. Fourth is the strong domestic macro fundamentals. Now, the resilience of the Indian economy is commendable, overcoming challenges such as the pandemic, lockdowns, the impact of the Ukraine war, inflation, the impact of the Israel-Hamas war, rate hikes, etc. Now, the upward revision for FY 23-24 growth estimates by the Reserve Bank of India to 7% reflects the strength of India's macro fundamentals. Next is the geopolitical advantage. India's adoption of the China Plus One strategy appears to be paying off, and this trend is expected to continue in 2024. Companies like Foxconn, Amazon, Google are making substantial investments in India, signaling a shift in global production dynamics. Now, this geopolitical advantage positions India as a favorable destination for international businesses looking to diversify their manufacturing operations. Now, these key events collectively paint a dynamic picture for India in 2024, with economic policies, political outcomes, and global shifts playing pivotal roles in shaping the country's trajectory. Now, before I conclude this episode, I would like to thank my colleague Merlin for bringing all the insights of this episode together. Now, while we've looked at what we could expect in 2024, we are keen to understand your expectations from the markets and from us in 2024. So please do drop in your expectations on the comment section below. Having said that, on behalf of everyone at Research and Ranking and Informed Investor, this is Raj Mehta signing off, wishing you and your loved ones the very best for a healthy, wealthy, and a fruitful 2024. Wishing everyone a happy and a prosperous new year. Thank you.
Did you like watching this video? Then download our app, Informed Investor, to watch more such informative and interesting videos.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.